Have you ever had a fall while learning how to ride a bike, been injured while skiing, read or heard about a plane crash? One common fact is that none of these are planned or intended, at least in most cases. Riding a bike, skiing, air travel, all of these are risky activities. A risky activity is one in which the outcome is affected by randomness. The purpose of this video is to understand what economic risk refers to and how to manage or tackle it. If your future income or wealth is dependent on the outcome of a process or an event, this process or event is said to have economic risk. It is extremely important to manage economic risk. Financial well-being or wealth of a family is dependent on the health and longevity of the family's income earner. Let us see how economic risk of the death of the income earner can be managed. Several risk management techniques exist, and it is the technique of risk transfer that is relevant in this scenario. Risk transfer is passing risk from one party who does not wish to have the risk to the party who is willing to take on the risk for a fee or a premium. Examples are life insurance and disability insurance. Let us look in detail about what is life insurance. Life insurance is a contract between an insured and an insurer where the insurer promises to pay a designated beneficiary a sum of money upon death of the insured person. The designated beneficiary could be a spouse or other dependents of the insured person. Insurance premium, a fee charged to a customer, depends on statistical data that exists about life history, age, and health, and applying this data into comprehensive formulas used by insurance companies. The amount of life insurance the insured requires or needs also depends on the standard of living that the beneficiaries intend to sustain. Several insurance websites provide the premiums one has to pay for a given amount of life insurance coverage. For example, if the standard of living in a family before the death of the income earner is $25,000 per person, the life insurance plan should be structured in such a way that the payments the beneficiaries receive enable them to sustain a standard of living of $25,000. Both life insurance and disability insurance reduce the intensity of financial uncertainty of the insured and his or her dependents. Death and disability are in most cases highly unexpected and unintended. Hence, one must secure his or her financial well-being and the financial well-being of the dependents through these insurance policies. Better be safe than sorry.